Holy smokers, the Relentless Warrior Award goes to SoFi stock. That stock continuing to battle. My gosh, even with all the Nasdaq shakiness and whatnot, SoFi stock continues to roll. Another 3.5% up on the stock here today, up 180% in the public count, up $75,000. Cannot complain about that one, okay? Listen, there's a stock I hold in the public count. Haven't talked about it too much recently, and this stock is such a screaming buy right now, in my opinion. And I want to spend a moment talking about that in this video here today, okay, here on the Reaction channel. Additionally, last night on the main channel, I released a video on my new bet against the stock market, a hedge I have on in the market, and I want to talk about a potential issue I could run into in regards to that hedge. I love to talk about risk factors and whatnot in regards to especially hedges. And I want to speak about a risk factor that I think is important we discuss in this video here today. Okay, so we'll talk about that, react to that at the top of this video. And then there's two videos up here I want to react to here today on the Reaction channel. First one up here, Wedbush, Dan Ives sees 1996 moment for tech stocks. This is going to be a really interesting one to react to. Obviously, this should be a very, very bullish video and commentary there. And then I thought, oh, this is perfect. Because then we can listen to Howard Marks talk about why he says stocks are in the early days of a bubble. I'm going to really enjoy sharing my opinions and perspectives on that one. One thing only I need from you guys. If you can please just hit the thumbs up button on this video. That's all I need from you. Just hit the like button. That will make my day. I hope you guys appreciate me spending the time with you guys and to do these videos and whatnot. And that's all I need, man. Hit the thumbs up button. If you want to be subscribed to the channel, you can certainly subscribe. I think we're at I want to say 105,000 subscribers on the channel, or 106,000, somewhere around there on the Reaction channel. I appreciate each and every one of you. Additionally, if you're looking to apply to join a private stock group, get access to all my course curriculums, my private Discord chat, exclusive weekly videos teaching you high-level subjects that you need to know in regards to the market and whatnot, right? Take your game up to a higher level. Pin comment down there, click on that fill out form. Let's see if we can get you in there in maybe the next week or so, okay? Alrighty, guys. So let's go ahead and let's have a little chat here, okay? So first off, when we look at the public count, we see what? We see a lot of success, a lot of great stocks, right? The Palantirs, Elfs, Meta, SoFi. I mean, the gains are astonishing, right? $148,000, $109,000, $998,000, $75,000, $150,000, $20,000, $126,000, $68,000, right? That does not include all the insane profits I've taken in these stocks. Like, I've taken hundreds of thousands of $1,000s of profits in Palantir, taken massive profits in Meta. Tesla was like a 2,000% gainer, took ridiculous profits in Tesla over the years, right? You know, it doesn't account for the dividends received, but there's sometimes we have a bad stock. And right now we have a stock that is performing poorly in the portfolio, and that is Honest, HNST. But the thing with Honest is, you know, I'm down 20% in this position. This is a stock that I believe is going to perform tremendous over the next 2 or 3 years. When I look at the fundamentals of the company, they do not reflect what I'm seeing in the stock price of Honest, okay? So what I see with Honest's business model, I see a business model that the revenues have been trending higher and higher. The margins have been trending higher and higher. The gross margins just went over 40%. And if you compare that versus 2 or 3 years ago, they were in the mid-20s, folks. That's how much this company's revived its gross margins. We see a company that is now flipped over to that profitability side, right? We see their cash flows have built up immensely. And additionally, we see a company that has one of the strongest balance sheets you'll find of any company valued under a $500 million market cap in the entire stock market. Like, you look at that balance sheet, it's insane. Loaded with cash to the sky. And, you know, no debt on that balance sheet. It's incredible. And a business model that's needs-based. Like the products they sell, beauty-related products, cosmetics, diapers, wipes, all the products they sell, like, they're very needs-based. And it doesn't matter if you're in good economic times, bad economic times, so-so economic times, like, their products are needs-based, right? So when I look at Honest, I think this is one of those stocks that, yeah, we're down on it a lot right now, 20%. But I think when it's all said and done, we'll have a very nice profit on this. And I'm looking at this short-term time period we're going through right now as a time period I want to add more to my position as public count. And I would not mind adding to the position and maybe getting it to 20,000 or 25,000 shares in the public count here. When I look at Honest, I see a company in which it deserves to be in the public count nowadays. I think 2 or 3 years ago, you could make a strong argument that Honest didn't deserve to be in there because it was not a strong enough company. I think if you look at this company and you look at the numbers they've been posting and you look at the trend of everything across the board, I don't care, revenue, margins, profitability, whatever metric you want to look at, balance sheet, everything is trending in the right direction for this company. And so I think this is a company that deserves to be a decent sized position on public count. Do I want this to be $1 million position? No. Would I mind this to be $100,000 or $200,000 position on public count? I think that's where it deserves to be when I look at the fundamentals of this company and how well the management team. Remember, when you buy into a company, you're buying a CEO, right? And the CEO of this company's turned the business around massively. Okay, so Honest. I got to speak up about this one. Like, I think it's a tremendous opportunity. I think people that are buying in the threes, I think they'll look back, a year from now or a few years from now and be very happy they were buying in the threes. Okay, we'll see. I could be wrong, and maybe the business model just gets worse over the next few years, and I just don't see that happening. The trend looks very positive for Honest. Okay, now next up here, we've got to talk about a potential problem. Okay, with my new hedge, right? My new hedge that I spoke about last night on the main channel. Okay, here's a deal. If we look at the hedges I had on at the beginning of this year, they did tremendous for me. Walmart, Costco, and then what was the other hedge I made a bunch of money on early this year? Was it Tesla? No, I don't think it was Tesla. I think that was the year before. There was another hedge I made a bunch of money on. I think I even showed it in the main channel video last night, right? And, so we went 3 for 3 at the beginning of this year in regards to hedges. All 3 made tremendous gains on, right? But there was a hedge I had on toward the end of 23 and the beginning of 24. And I talked about this stock a lot at the very end of 23 and then going into the first half of 24. Okay. And it was Chipotle, CMG. And I spoke about the problems I saw coming in regards to Chipotle. I talked about the valuation. I talked about how, a lot of moves that Chipotle was making to make the quality worse, in my opinion, restaurant experience worse, was all going to come back to bite them. And eventually they were going to be hurt by this significantly, right? But the issue I had is my timing was not perfect in regards to Chipotle. Actually, when I was speaking about that at the end of 23 going into 24, the stock just kept going up and up and up and up and up. Kind of like when you go long a stock sometimes and you're like, this company is amazing. Like I'm going to make so much money from the stock over the next 3-5 years. But when you first buy into it, it just keeps going down and down and down. And you're looking, you're like, oh my gosh, man, I just keep losing money on the stock. Like, and you go down 20-25% all of a sudden. But Chipotle was opposite. It just kept going up. But I ended up being right on Chipotle, right? My timing was not right? It just kept going up right in my face. But at the end of the day, like, you look at all the times I talked about Chipotle at the end of 23 and in that first half of 24, everything I said ended up coming true in regards to Chipotle. And we see it in its latest numbers. Things that are happening, like, no one saw this coming other than me. No one ever spoke about this and thought Chipotle could report restaurant sales decreasing 4%, comp restaurant sales. No one spoke about that. Everybody thought, because Chipotle had just been reporting for the longest time ever since they went through the E. coli disaster, right? They'd been reporting for the longest time comp restaurant sales up, up, up. People did not think it was possible that their restaurant sales would decrease 4%. That's like crazy. Now people are like, oh, dang, it happened, right? Operating margins of the company decreasing. Their operating margins are going down for Chipotle, and not down by a small amount. It's actually down by 150 basis points. Operating margin went to 18.2%. That's a decrease from 19.7%. That's significant in the restaurant industry. Restaurant level operating margin was a 27.4%, came in at 27.4%. That's a decrease from 28.9%. Diluted EPS down for the company. Adjusted diluted earnings even decreased for the company. That's when you take out one-off things and all this stuff, right? And so, everything I said in regards to Chipotle came back to bite them, right? I talked about, how all the wages increases in California was going to hit them, right? It's clearly hit them, and it hit their profitability, hit their margins. They had to go up so much on their customers that their restaurant sales are now going down, right? And the quality went down, and it shows. And so, that could happen with my new hedge, where maybe I'm 100% right on what ends up happening with that company, the overvaluation, what I think is a peaking in regards to user numbers and things like that. But maybe at first it goes up, right? So far it's gone down, but maybe at first, maybe we look out 2-3 months from now and it's like, dang, my hedge is doing horrible. That's possible. So anyways, I spoke about that on the main channel, but I just thought, I think it's important. You always got to factor in risk factors whenever you're going long stocks, or, if you're betting against a stock and you're buying put options as a hedge here, right? And one last very important thing I want to say before we move on to these videos, okay? Listen. And I said this last night, but I need to say it again. Hedging is not for everybody. Hedging is not for everybody. This is a high-level game. When you got millions of dollars in a portfolio, it can make sense to hedge, right? Your high net worth individual, it can make sense to hedge. You got a lot of experience in the market, it can make sense to hedge, but it's not for everybody. It's not for everybody. And some people, think they need to hedge their, $40,000 portfolio. It's just, come on, man. At that point, you need to just focus on income, expenses, and just plowing money into your portfolio, buying great long positions that you believe in the next 5-10 years. That's the name of the game. You got a $40 million portfolio, you got a $40 million net worth, it's a different game. It's a different game, okay? Not everybody's playing the same game. The guy that has a $4,000 portfolio is not playing the same game as a guy that's got a $4 billion portfolio. They're not the same, okay?
We've had, anytime you have a big rally, you're always going to have these daily pullbacks, even weekly pullbacks, if you will. That doesn't necessarily mean the rally.
Like, you think I was worried about hedging a portfolio back when I had a $100,000 net worth in like 2012? Of course not. Come on, it's not even worth my time. It's not worth my attention. Was I worried about hedging a portfolio back when I had a $200,000 net worth when I was like 24 years old? No, come on. It's not. But you get a 8-figure plus net worth. Okay, all of a sudden this stuff starts to become important. Hedging.
Over, and I do wonder if you see enough fundamental case there for this rally to reset and continue.
Yeah, look, I view it as a bump in the road because it's our view. When you think about AI revolution, you're just continuing to get validation from earnings and from everything we see from the data center, as well as just overall demand. We'll see that from Godfather of AI, Jensen, NVIDIA, as we go into next week. And look, I continue to view this is a 1996 moment, not a 1999 or 2000 moment. And that's our view. I mean, this is a tech bull market that will continue to rage on in second half of the year into next year, given we're talking about a fourth industrial revolution that we're actually just living through.
When we talk about that fourth industrial revolution, everyone, of course, wants to know how that includes stocks other than, say, NVIDIA or Microsoft. I know we've talked about this before, the idea of the AI trade broadening. And it does appear investors are hungry for that, looking for who the next beneficiaries of this are going to be. Are they visible yet?
I think they're starting to be visible. I mean, we have our AI 30 list where we talk about the derivatives. It's not just, look, of course it's led by NVIDIA, it's led by Microsoft, it's led by, big tech, Meta and others, but now it's second, third, fourth derivatives. Nebius is a good example. You never would have talked about them a year ago. You look what's happening on cybersecurity. You never would have said it as an AI name, Palo Alto, CrowdStrike. You look on Palantir. 2 years ago, no one talked about it. A year ago, maybe, haters would talk about it. Look what's happened there. And the sell-off today, I just view as just a small bump in the road to what I believe is $1 trillion market cap in the next 2 or 3 years. So my view is, and that was a great illustration when you talked about, it's going to spread. Second, third, fourth derivatives. And I always say, when the bears are in hibernation mode, they can see
I got to push back against Dan here just a moment, right? Listen, he's just brought up Palantir. You know what he said? He said no one talked about Palantir 2 years ago. Listen, that might be true for Wall Streeters. Yeah, they weren't talking about Palantir 2-3 years ago. That's true. But there was some of us on YouTube that talked about Palantir a lot. I mean, I talked about Palantir so much in 2022 and in 2023 as well, right? And I was buying my shares, and I built to like a 5,000 something share position in the public account for Palantir, right? A significant position. And we know the rest is history, right? And, I wasn't the only one. Amit's another great example. Amit, spoke about Palantir so much. I mean, I think he still does, but back then, and yeah, there was not a lot of people talking about Palantir very much out there. But there was a few of us retail investors that were talking about it a lot and understood the opportunity, right? And we took advantage and we bought that massive crash in Palantir when it went down to, $7, $6, $5, right? $8, $10. We were buying and we were buying and we were buying and we built out great size positions. And obviously, the rest is history now. But don't say no one was talking about it, because there's some of us, YouTubers, where we were talking about it and we talked about it and we talked about it and we said we were buying it, and it was a great opportunity. And, Wall Street wasn't. But man, has Wall Street talked about it a lot the past year.
In the spreadsheets.
One thing that I found interesting about the rally, certainly this particular year that we've been in, is sort of the participation that we started to see amongst old tech companies. We talked a lot in the past on this program about Oracle. Today, we take a look at Intel, and I know Intel has a lot of issues. But to see not just so much the rally in the shares today, but the vote of confidence that Masayoshi Son and SoftBank had to put up $2 billion to invest in this company, do you think Intel is going to find a spot in this with AI revolution, tech revolution, whatever you want to call it?
Look, I think the problem is they're just years behind, right? In terms of, you look at what Intel has done the last few years, has been just a massive black eye. Now, clearly, like SoftBank vote of confidence, obviously U.S. government, that's a little, call it obviously a champagne moment today. But I just think this is an Everest-like uphill battle. They're years behind other competitors when you look at NVIDIA, AMD, TSMC. And I just think, look, there's a better chance of me playing Ryder Cup Bethpage in September than Intel catching these other chip players, and that's the reality.
So what do you think Intel can be, or more importantly, what do you think it will end up being? Does it get bought? Does it get chopped up and into different pieces, or does it just kind of wither on the vine and go away?
I think chopped up. It's going to have to be strategically split. I mean, that's our view. Look, I get right now you're talking about one of a core U.S. tech asset. You look at their customer base, but the reality is, like, market's telling you, I mean, of course you had today, but strategically that this is probably a company that's going to have to split up. I think that's part of the problem, is that these tech companies, when you look at the ones that participate, they're so far ahead of the competition. And Intel, they've been on a treadmill, almost, 2.5 speed or lower.
That's funny. So what do I think about Dan Ives' two main points there about, let's talk Intel first and kind of my views there, and then let's talk about 1996 moment. We're in the market at not a 2000 moment or 1999 moment, okay? Intel, here's the deal. Yeah, he's 100% right. They're miles and a half behind NVIDIA and AMD, right? That's good luck. It doesn't matter, Masha-san can invest whatever from SoftBank. Trump can do whatever. You're not catching NVIDIA and AMD. It's completely unrealistic. They don't have the DNA at that sort of company. And, even if they did ever catch them, it's going to be 5-10 years from now. Like, you got to understand, like, to catch somebody, it's a long process. As AMD on the way back to their recovery, right? When Lisa Su pulled off of it, like, that was pretty much a miracle that Lisa Su pulled off. I mean, remember, AMD went under $2 a share. It was a $2 chuck. I think it bottomed at like $1.60 back about 10, 11 years ago, right? Now we look at AMD, it's a giant. But it was a long road to get to the place it is now. And it was pretty much a miracle. I mean, it was honestly like what Lisa Su and the team pulled off at AMD was pretty much a miracle. Can Intel pull a miracle? I don't know. Especially in regards to catching NVIDIA and AMD, that's good luck. Now, especially with how fast, because you got to understand, NVIDIA is moving so fast because they know AMD's right behind them, right? So they keep the pedal to the metal in NVIDIA, and AMD's moving so fast because they're always trying to catch NVIDIA. So if anything, those two companies are getting like more ahead of the rest of the world in regards to chip space, because they're just so like pushing each other so rapidly. So what is Intel left with? I think they got to try to be a semiconductor manufacturer. I think they've got to try to be a TSMC. I think that's their best bet. That's going to be difficult as well. TSMC is a very impressive company, but in my opinion, that's their best avenue. If they think they're going to make better chips than what AMD makes and what NVIDIA makes, I don't know, man. I have a lot of doubts about that. Could I see them potentially down the road trying to compete with TSMC? Maybe they undercut pricing, right? The government backs them. Maybe if they can do somewhat of a good enough job like TSMC does, but they undercut pricing, maybe, right? And the government supports them and all this stuff. Yeah, maybe. And then maybe we actually got... I wouldn't mind that either. I think that would actually be a good thing because I feel like TSMC has no competition right now. Literally, like, if you're a big chip maker and you want to make chips, you got to go to TSMC. So I actually wouldn't mind it if Intel actually became a serious competitor over the next 5-10 years against TSMC. I think it would be a great thing for America. I think it would be a great thing for chip companies. Okay. No, what do I think about Dan Ives' point about we're in a 1996 moment? He could be right. And here's why. NVIDIA is going to keep growing. Right now, the growth rate is going to slow. And I keep cautioning everybody and letting people know NVIDIA's growth rates are going to slow substantially in 26. Everybody's got to get mentally prepared for that, and in 27 as well. Okay? But AMD is going to see major revenue growth acceleration over the next 2 years. Okay? So when you think about all these big dog customers, Meta, Microsoft, Google, like go down the whole list of them, right? Listen, these companies have almost infinite resources. The money just keeps pouring in. The money's not going to stop pouring in. The economy can get a little better, it can get a little worse, it can stay around here, and the money's just going to keep pouring in. And those companies, they do their share buybacks, they do some dividends here and there, but they like to spend aggressively on their businesses for the next 10, 20-year opportunities, right? So spending aggressively, I don't see that stopping. Like, they might slow in some areas here or there, right? Some spend might go from NVIDIA to AMD over the next few years. Things like that can happen. But at the end of the day, like, the spend will increase. It'll increase a much smaller amount. But remember, like, if you had a guess, outside of a colossal recession, is Meta going to be making way more money or way less money 3 years from now than today? Way more money. Is Microsoft going to be making way more money 3 years from now or way less money? Way more money. What about Google? Same. Like, you run down the list of all these big dogs that are spending all this money, right? So just something to factor in. Howard Marks on early days of a bubble in the market.
That you pose yourself. Why are asset prices so strong in the face of what you view as net negative?
Oh, by the way, Howard Marks, he's got a great book. I keep it beside my bed, actually, on Mastering the Market Cycle. Very, very good book if you're ever looking to read that. There's a lot of important lessons in there and understanding the market dynamics and the cycles that the market goes through.
Howard, can you share your thoughts with us?
I'm glad to be with you this morning. Of course, as the quote you just put up on the screen indicates, this is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections.
It's just not accurate, Howard Marks. In all due respect, that's just not accurate. Listen, from the peak in 2021 to the trough in 2022, the Nasdaq fell over 37%. And that was over about a year time frame. Okay, from the peak in Q4 2021 to the trough in Q4 2022, Nasdaq fell like 37%. If that's not a severe major correction, what is? What is? That is extremely severe. Okay, the S&P 500 over that time, I believe it fell 25% or so. That's very serious, and that was over about a year's time frame, right? Because the market kind of peaked like November 21 and then troughed around October 22. That's serious stuff. Okay, is it as bad as it was in the Great Financial Crisis when the Nasdaq fell over 50%? No, not that bad. But 37% is no small amount. Okay, you talked about many of the best, most well-run, most profitable tech companies in the world. Some of those stocks fell 30, 40%. Others fell 50, 60, 70, 80%. So, like, this notion of, like, we haven't had anything crazy since no, we have, right? Now, the Rona crash, where the market went down 30+%, that was a rather quick one, right? That was really sharp down and really sharp up. That was extreme V. So, I can understand if people kind of disrespect that crash, right? Don't take it that serious. What we had in April, when the market fell around 20% or so, very quickly, I can understand if people don't take that serious because that was a very sharp V-shaped recovery. 2018, we had some nastiness at the end of the year where the market fell 20+% from where it peaked at in September of 2018 to where it troughed at in, right before Christmas that particular year. That was pretty serious. Is that a great financial crisis? No, but that was pretty serious. But also, everybody thinks the great financial crisis is something that just happens all the time. It doesn't always happen. The whole banking system nearly collapsing. Do you know how rare that is? I don't think people, Howard Marks is extremely educated on the market, but yet has this notion of not understanding base premises of that's not normal. That almost never happens. We've almost lost the banking system 2 times in history. Okay, since the kind of, you could look at modern day banking system, right? The last 150, 200 years. We almost lost it twice. Howard Marks knows this. Once was in the Great Depression, right? And the other was a great financial crisis. And that's it. So that's an event that might happen once every 80 to 100 years. And the stock market crashed over 50%. Peak to trough. Severe. But if you're expecting the whole banking system to collapse again, it might someday. 50 years from now, 60 years from now, 70 years from now. That doesn't just happen all the time. Every 10 years the banking system collapses. No. That, someday that might happen again. A long time from now. I might be a man with full of hair like that when that happens again. It will happen again, right? But it doesn't happen very often.
The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen.
Yep.
Whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors.
I don't know. I disagree with him again. He just said doing it on leverage has worked out very well. Disagree, Howard Marks. Listen, if you were on leverage early this year, you could have got stopped out of the market. With how dramatic that drop was in March and April from where we peaked at around February 19th to where we troughed at around April 9th, oh my gosh. Stocks were getting obliterated. If you were on margin at that particular time, you got wrecked. If you were on margin going into 2022, you got beyond wrecked. Because let's be honest. The people that do margin are the same type of people that would buy NVIDIA stock or Netflix stock or Shopify. Those stocks fell 80%. Right? NVIDIA fell 50% peak to trough. Netflix fell 70, 75%. Shopify fell 80%. That's the same type of people would buy those sorts of stocks. Small cap stocks got absolutely obliterated. So I disagree. That's just not true. You've been on margin, you could have got wrecked. You were on margin going into the 2020 crash. Oh my gosh. You might have lost your whole portfolio. So, no, it has not been a great time to be on margin anytime in the past few years with how you get these dramatic crashes. Because during that, you get those margin calls. And next thing you know, you lose half your portfolio. Half of it's gone. And then the upside comes, and then you're not even on margin anymore because you got margin called. And you're oh, great, I lost half my portfolio, had to be forced to sell. And now you can't participate on the other side the way you want to.
By nature optimistic, and that optimism dies hard, I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much, and that's the continuation that creates bubbles, and we probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations. Is there?
Now, Howard Mark's point in regards to valuation with stocks, completely fair. I don't care what you look at, price to book. For the overall S&P 500, you can look at trailing 12-month P, forward P. They're all extremely rich, right? That's fair. That's an easy one to point out there. The other part I'll push back here is around the psychology of the market. Because what is the main thing you've seen continuously this entire year? Okay? I want you to look at something very important. It's called the AAII investor sentiment. Overwhelmingly bearish the past 6-7 months. Overwhelmingly bearish. Far superior to, really any time period you look at since that survey's been done in the 1980s. Like, if you look at how bearish investors are on the market the next 6 months, and you look at the data for the last 7-8 months now at this point in time, it's been overwhelmingly bearish. You can look back all the way back to the 1980s. I think you'll have a hard time finding any time period that was this bearish for 7 months. Incredibly bearish. And so, it's not like there's like this euphoria feeling like, oh, investors are like only bullish on the market the next 6 months. The data shows they've been bearish and bearish and bearish and bearish. And yet, despite that, we've hit all-time highs.
Time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97 when the market was kind of falling in love with tech stocks. And, the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet. Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. Remember I said we're in the early days. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive. They may go on to become more expensive, but the fact that they're expensive, it should not be lost.
And Howard, I think a lot of people point to, in terms of the echoes of the late 90s, the tech sector of the market as being the most overvalued. What I thought was so interesting about your memo is that wasn't your take, that wasn't your bigger concern in the market at a time when people are counting on a certain robustness of growth and a certain kind of inflationary backdrop. Why is it that tech isn't the focus of your concern this time around?
Tech contributes to the aura that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet, have been contributing disproportionately to the rise. And they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued, not as highly as the Magnificent Seven, but nobody says they're the same quality company, quite highly valued relative to history. And it is the fact that high valuations are being applied to more average companies that I think's more alarming than the fact that exceptional valuations are being applied to exceptional companies.
Howard, there's a quote you use in this memo. I enjoyed this quote. You said, "He who knows only his side, his own side of the case, knows little of that." And then I worked through the rest of the memo, and there was a conclusion there about credit. And I just wonder, sir, whether your focus on equities in this note offers you a greater perspective on how much value is offered in credit right now.
Well, it's as John Stuart Mill said in, I believe it was 1859. You have to know all the sides of the story to understand whether your side holds water. And I cite the bull case there for why the market isn't overvalued. I think that's
okay. So, what do you do? What do you do in a situation like this, right? You got Howard Marks saying, I'm worried about valuations, which is a completely fair point, but the market could go up for another 2-3 years, right? Like what happened with Alan Greenspan, the irrational exuberance, all those sorts of things. What do you do as an individual investor? And you're looking and you're like, dang, maybe the market's rich, but maybe some stocks are really overvalued and some stocks are actually undervalued here. Here's what you do. You focus on what you can control. What you can control is making sure you got more income than expenses, investing on a steady basis every month, every few weeks, finding great opportunities in the market. There's plenty of opportunities in the market on significantly undervalued stocks that are going to do tremendous in the next 5-10 years, regardless if the market crashes in the next few years, has a correction in the next few years, because guess what? Corrections happen in the market, and you got to invest right through those. You invest before the correction, you invest during the correction, you invest coming out of the correction, the crash, whatever it is. And that's fine. Like, those get over. Like, a small correction might last a month or two. A major, severe correction might last 3 to 6 months, right? And a crash lasts usually 1 to 2 years. Big deal. And you just buy right through that the whole time. So, you can wait it out and hope you can time it out perfect, but it's a losing game. We know that. It's always a losing game. You've got to invest right through it. You've got to find those opportunities that are phenomenal. And if they get cheaper because the market goes through a correction or crash, great. You get to buy those stocks for even cheaper, right? AMD, you could have started buying it before the severe correction we had in April, right? And you could have started buying AMD at, 110. And at the bottom, AMD went into the 70s, right? So you could have bought at 100, at 90, at 80, and, at the very bottom when it bottomed at the 70s. ELF is a great example. You could have been buying that before the severe correction in the 90s, and then ELF went all the way down to, I think it was $50 at the lows, right? Or $49. You could have bought some more. As long as you got more income than expenses every month or every 2 weeks, right? You're always ready to buy. And you could have been buying ELF as it went down from 100. Say you start your position at 100, you bought more at 90, you bought more at 80, you bought more at 70, you bought more at 60, you bought more at 50, then it starts going up again, you buy more at 50, you buy more at 60, more at 70, more at 80, more at 90, more at 100, right? Then you pull back your buys. Now you just loaded up on ELF, you probably got a cost basis of $70 or so. And the stock today is what? 115, 120, somewhere around there. You've already made crazy profits. And that's in a short amount of time. You're probably, if you're a long-term investor, you're thinking about ELF for the next 3-5 years. And you're already sitting pretty. And that's despite you starting to buy before the major correction came. That's how you play this game on a higher level, man. You focus on what you can control. I can't control if the market has a correction tomorrow, next week, next month, next year, or crash or whatever. Like, that just is what it is. That's just part of the game. We buy. We buy great assets. We hold those great assets. We let them appreciate over time and make us a lot of money. And that's all good. Okay. Appreciate y'all for joining me. Thank you so much for being there. If you're looking to apply to join private stock group, get access to 1000xstocks.com. All that good stuff. We'll send you your Steel membership cards in the mail once you join us in there. That will be the pinned comment down there. Let's get you up to a much higher level than where you're at and start focusing on building wealth, right? Much love and have a great day.